Thank you for tuning in. This is the Rice Crypto Show, and I'm your host, Rice. And on today's episode, my guest is Lynette Zang. She is the Chief Market Analyst at ITM Trading. And this is actually going to be my fourth time interviewing her. So I'm going to have links down below so you can check out the previous 3 interviews that I did. Now, before we get into it, this is your first time ever checking out any of my content, I do encourage you to explore my channel. If you already check out my content and you're not subscribed, what are you waiting for? Make sure you smash that like button, hit the notification bell, and before we get into it, a message from Monarch Wallet. All right, ladies and gentlemen, like I said, today's guest is Lynette Zang. She is the Chief Market Analyst for ITM Trading. She's been involved in banking, stockbroker. She's been involved in studying world currency since 1987. This lady really knows her stuff. She teaches people how to survive and thrive through the inevitable coming collapse. And her motto is food, water, energy, security, community, barterability, and wealth preservation. Lynette, thank you again for coming back on the show. How are you doing today?
Oh, I'm doing very well. Thank you, Chris, and thank you for that wonderful introduction.
It's no problem, and I appreciate your time. So this is interview number 4. I'll have links down below for the 3 previous interviews, and I also have a playlist created, so you can just watch them all by just checking out the playlist because YouTube seems to like playlists. So let's go ahead and just kind of get into it. How's everything been going on with you since last time I talked to you, just personally? How's life?
Oh, personally, life is really good. The gardens, it's getting to be spring planting, so there's lots of activity on my farm, getting ready for that. And I've been eating some good greens. It's been a pretty warm winter, so I even have bulbs coming up really early, and I never lost all my moringa, which is really nice. So yeah, no complaints.
I love what you're doing with the farming and the community farming. I think that's a really cool thing with the community building, especially when we think about the coming collapse and ways that we can be able to still be able to maintain eating healthy food. So, I definitely commend you on that.
I mean, I got to say, even eating any food, because when you look at what's happening in different parts of the world, specifically India, year over year, their food prices spiked 60%.
Right. Venezuela.
I mean, Venezuela, exactly. China, even, Africa. So I think regardless of really what's going on, we need to be able to be as self-sufficient and independent as possible just to sustain a reasonable standard of living.
I agree 100%. I do. And a lot of this is caused by what I'll get into is the first official question. And then I'm not going to be redundant in the things that I've asked you. So I do encourage people to check out the past interviews. If you're not familiar with Lynette Zang and ITM Trading, I'll have links down below so you can check out her channel. She has some really awesome videos. So I definitely encourage you to check it out if you don't already check out her content. So in 1913, we had this creature born on Jekyll Island known as the Federal Reserve. And I say that because I'm a big G. Edward Griffin fan. I like his book.
Me too.
But this isn't even a federal entity. It's like the Federal Reserve or the Federal Express calling themselves federal. It's just right. A name. So since they became into existence in 1913 and took control of our currency, the US dollar, which ultimately became a world reserve currency, how much value has been lost since the Federal Reserve has come into play?
Officially, over 97%. I believe it's something like 97.6-ish%. So getting toward 98%.
So can you explain that in simple terms for somebody that doesn't understand
Sure.
a 97% loss of something?
Yeah, absolutely. If you go back, well, when the Federal Reserve was given full control over inflation was 1971. So we can go back that far, and some of your viewers may have been around like I was at that time. And at that point, the average income for the average family was $9,500. And a family of 4 could live comfortably. I'm not saying extravagantly,
Right.
but you only needed one wage earner to support a family of four. I think today the average wage is what, 56,000 or something like that.
I think that's the
And
medium.
it's somewhere in that vicinity, which sounds great because, hey, wouldn't you rather have 56,000 than 9,400? Absolutely. But how's a family of four doing on 56,000? Chances are pretty good you need two wage earners, and even if they're both getting the average wage, unfortunately, even at 100,000, they're still typically living paycheck to paycheck.
Now,
So
is this what you would call inflation?
it is exactly what I would call inflation,
Okay, you see, I
which
mean, I just want
by
people to be
design.
educated here.
Yes, okay. Well, all right, then let me take you back a little bit because it really matters. You know, what is the function of money? Money will have a number of functions, but if you have a designated money, it enables an economy to specialize. So you have a banker and you have a baker and you have a lawyer and you have a real estate agent, whatever, but they specialize. Otherwise, you'd have to do everything yourself, to grow your own food and take care of the sheep so you could make your own clothes, etc. So over thousands of years, they tried lots of different things to see what could be used as money. But the only thing that actually meets the prerequisites to be good money is gold. And gold is a labor-based money. And it's also indestructible. And that's one of the key features. It also can be divided. I mean, you can have an ounce, you can have a tenth of an ounce without a loss. Like you can't do it with a diamond or a stone because when you make it smaller, it loses value.
Right.
But that's not true with gold. So for governments, though, that want to tax you and spend, well, if they tax you on a gold standard, you know about it and you might not like it and you might have pushback. So they came up with a fiat money standard. The definition of fiat is by decree, but the bottom line is it is legalized money. So in a fiat system, inflation is part of the design, because for governments, it enables them to tax you without having to go through legislation and make it visible. But as we all know that have lived through inflation, and we all have since the day you were born, if it costs you more and more to buy the same goods and services, is it because those goods and services have become that much more valuable? Or because the money you're using to buy them has become that much less?
Yeah.
So the advantage for, I mean, it's genius, but the advantage for governments is they get to tax you without going through legislation. For corporations,
a hidden form of taxation.
absolutely. Yes, absolutely. And if they can keep it at 2% a year, well, you're still losing 2% of your purchasing power value over a year, but it's small enough that you probably don't notice it. And that's how we've lost all of that value over this period of time.
It's insane when you think. I'm sorry, go ahead.
I'm sorry, because this is like such an important point, is for corporations, this is what has enabled income inequality, because the average wage by design is never going to keep up with inflation. And what do we use to gauge inflation? Aside from the Federal Reserve changing things to make it look however they want it to look, but it's the goods that are produced by these corporations. So they use, and so for corporations, it enables you actually agree to earn less and less over time, and the corporate profits go up and up and up, and there you go. There's your income inequality. I think I just saw a piece recently in the 1970s, actually. The difference between the CEO and the average worker was 20 times earnings. Now the average is 300 times earnings, and many are making like 5,000 times what the average worker earns. Now, I'm not saying that the guys running the corporation aren't entitled and don't earn that much more money, but it's that inflation piece that enables it. Because what that creates is called nominal confusion. We marry those numbers. Woohoo! I'd rather get 56,000 than 9,500 or whatever, except that it doesn't buy you as much. However, had you been paid in gold ounces, and remember, 1970, that would have been $35 an ounce.
Mm-hmm.
So if you divide the average wage by the cost of an ounce of gold then in reality, and you did not get a raise, not one penny, but you were still paid in the same amount of ounces, that'd be somewhere in the vicinity of 240, 280,000. You guys can do the math. And that would maintain your standard of living.
Well, you did a great job explaining that, and I really appreciate it, because that's one thing that I feel like I like talking economics, but some people get really bored by it, and being able to explain something in a simple way that they can grasp and then compare it to something else in life, it seems to stick a little bit harder. And
yes, and it needs to.
And it's definitely time for people to wake up. And so, I mean, in the previous interviews, we talked about a lot of different things that are leading up to this inevitable collapse financially of our economic system globally, not just in the United States. Right. Since I've interviewed you last, we've had an inverted yield curve. Do you mind explaining a little bit about what the inverted yield curve is? I mean, I've told people, but if you don't mind explaining it, and then kind of explaining how that's important and how it relates to what's going on currently.
Okay, and it goes back to the monetary system today. How money is created is by creating debt. So if you or I go into a bank and borrow, say for a house or a credit card or any kind of debt, then the bank can create that new money into the system. Well, what are interest rates? Interest rates are the key tool that excuse me, that central banks use to get you to either stimulate the economy or to slow it down and create faster or slower inflation. Because in theory, at any rate, if interest rates are lower, then people go out and they borrow more, and therefore they spend more, and therefore that stimulates the economy. On the other side, if inflation is running hot or high, and you and I would notice it, they want to slow that down. And that's actually the genius piece that these central bankers came up with, was controlling the rate and speed of inflation. Right. So if they want to slow it down, they raise interest rates, then fewer entities borrow and spend, and then that slows it down. The problem is, when you enter a crisis in this country, the average amount that central banks, the Federal Reserve, drops interest rate is something like 5.5 or 5 3/4. Mm-hmm. So, and that's what happened. That's pretty much where we were in 2008 when the crisis hit, and they dropped it, bam, down to 0.
Right.
Well, what are they really supposed to tell you? Number one, they're supposed to tell you about the value of the currency into the future, right? So let's say you're going to loan somebody money for 30 years. You want to get paid a higher level of interest to make up for that inflation, right?
Right.
But if you only need it overnight or for a short period of time, then typically it's lower. The interest rate would be lower because you're not going to get as much inflation. In addition, interest rates are supposed to reflect the credit worthiness of the borrower. And what are we told supports the currency? In this country, it's the dollar, but this is true all over the world. It's the full faith and credit of the government.
Right.
So if you interpret those words, as long as you trust them, you have faith, then you're going to continue to loan them money. So it's really a government's ability to grow more debt. All right. Well, interest rates peaked as we were kicking off the pure debt-based system in the 70s. They went up and they peaked with the Federal Reserve rate was somewhere a little bit more than 20% in 1981. And for those of us that remember that period of time, I remember having a 5-year CD at 15%. And they've been going down steadily ever since, because obviously the higher the interest rate, the higher the interest payments. And the more debt you take on, it creates a challenge. So we've seen interest rates go down and down and down. Now, to go to the inverted yield curve.
Okay.
An inverted yield curve is when your shorter term interest rates are higher than your longer term interest rates. And technically, that has been an extremely accurate predictor of recessions, of coming recessions, because money is a lot more expensive on the short term.
Hasn't it been 100% accurate every time it's come about?
It has been.
Okay.
Yes.
Okay.
Yes, actually, thank you, because you're right, it has been. And we were running since last December. Now, this changed, interestingly enough, this changed in September, right? But from last December, a year ago, last December, the shorter term rates had been higher than the longer term rates. Different ones, because, you know, you can do 3 months to 10-year to overnight to 10-year, etc. But you would get paid more overnight to loan money overnight than you were to loan it for 10 years.
Right.
Now stop and think about that. Does that make any sense?
Not at all.
Exactly.
And that's what I don't get about what people don't get. So.
Well, because people don't really, first of all, they don't understand how money is created and supported in the system. And it's not really people's fault, because this should be taught in grade school.
Right.
But if they actually did, then you would say, I'm not going to work for your debt that I have to repay. I'm not going to work for these dollars at this level when you're making so much more than I can make, right?
Right.
So, and it's the same thing, frankly, with the stock market at all of these highs. Nominally, but the valuation, the true value of it is so stretched, it's ridiculous. But people get blinded by numbers. So in September, the short-term repo market froze. In other words, this is an overnight or a 14-day market where banks would loan money to.
This is actually going to be my next question, is asking you to talk about what's going on in the repo markets and explain what the repo markets are.
Yes. Well, the repo market, so I'll go there, because it's all coming to a head. They all come together. It's not that's that and this is this. No, it all flows together.
Well, that's why I'm asking you these questions. So
perfect.
We're on the same page.
Absolutely. So the repo market is the global plumbing of the financial world. And typically, money market funds fund the repo market. And the banks are the ones that really control the repo market. And they loan that money overnight or 14 days to other banks or hedge funds or other private investors.
Right.
So think about what happened in 2008 when the prime money market fund froze and people couldn't get their money out. And even when they finally did, they didn't get 100% of it. And it took a really long time. But that's when the government came up with these new rules to prevent you from easily liquidating and taking your money and creating another run on the money markets.
Right.
So there wasn't, they had all these entities that wanted to borrow money and nobody that would loan it. And so they froze. Boom, done. That is what will create the next crisis, is some kind of freezing in the system. And so the Federal Reserve and global central banks went in and started creating lots and lots of new money. Don't call it QE, which is quantitative easing. which is printing money for free. Don't call it that.
Yeah, it's
but
not
that's
that.
exactly what it is. They
Yeah,
just don't
no.
want you to call it that.
No, I agree. It's definitely quantitative easing. And had it not been for QE 1, 2, and 3, we wouldn't have got out of the financial crisis that we saw in 2008. So they just printed up the problem, which is why you talk about everything being on life support and zombie banks.
But let's kind of back off on that and back up a little bit.
Okay.
Because you said that's why we didn't go through a crisis then, and yet you've got 40% of the population that can't come up with $400 in an emergency.
Well,
so who really got through the crisis?
Right. The people who have wealth.
And even more than that, just at the tippy top, because even your high middle income earners, which is not slouchy, you know, we're talking probably about something like 500,000, 800,000 a year.
Right.
They've actually lost wealth. It's that 1% that actually gained wealth, because inflation enables wealth to transfer to whoever gets paid interest, which are the banks, which are the elites, right?
Yeah.
So the repo market is pretty significant. And ever since then, well, what has our Federal Reserve done? Lots of new money for free. And Megan, you know those 3 links to the Federal Reserve, their balance sheet, and showing you the repo operations. We'll give those to you so you can post those as well, so people can see that as well. And I will say, when you're looking at those charts and graphs, if you see the line going up, that's new money. If you see it going down, well, then what they're doing is they're taking money out of the system, or liquidity out of the system, and they've committed to basically unlimited amounts of new money.
Because
they're doing it faster than during the crisis.
It was supposed to be temporary, and then they just continue doing it. Like, how much are they printing up right now digitally daily? Is the Federal Reserve printing up for the federal market with these capital injections?
Well, they're committed to $60 billion a month. And if you look on the Fed balance sheet, you have the link, you can see that that is really what they're doing. And what they're doing is, with some of that money, some of it is going into, and they have repo operations, but a lot of it is going into buying short-term treasury bonds to push those short-term rates down so that the yield curve is no longer inverted. Doesn't mean that what it was telling us about went away, just be clear on that. And the 3-month to the 10-year is getting very, very close to inversion again. And what that tells us is that all of this money printing that they've been doing, trillions and trillions and trillions of it, it's not working. It's not working.
It's not. No, my cat is like in a super affectionate, lovey mood. So I'm letting him do his thing here. So I apologize, but.
Well, he must like this interview, so that's
maybe he's liking the energy. But yeah, no, I agree with everything you're saying. And one thing that I realized is how the capital injections are affecting the overall stock market. It's making our stock market look good when it's not really good. Can you elaborate more on that?
Oh, absolutely. Because when a central bank creates money, if you kind of think of it like a big wheel, and in the center is the hub, so the center is the central banks. Well, at the moment that they create that money, it has the most value that it ever will. And then it goes into that next layer, which are the banks. It doesn't go to, even when the government borrows money, it doesn't go directly to the government. The government has to pay the banks to borrow that money.
Right.
So once it goes into the banking system, then the banks, what do banks do? They loan it out for stocks, for bonds, but they can also use whatever deposits there are, and also this money for free, to gamble, because interest rates being this low for this long, and actually this happened, you know, even before 2008, it's what created the crisis. But banks loan it out. So the central banks globally have told all of these elites that they're going to give them as many new in this country dollars as they want. Why wouldn't the stock markets go up? They're borrowing. It's done on debt, and it's done with these derivative bets, which are just bets. You can't convert them into anything ever, and they're just about leverage, which is debt upon debt upon debt upon debt upon debt. So, you know, yeah, the markets love QE.
It's crazy. It's insane when you really think about it. When you know what's going on, it's absolutely insane.
It really is. But look at what happened in Venezuela, right? The markets got so high because of their hyperinflation. In 2013 and 14, they had the best performing, probably even last year, they had the best performing stock market on the planet. But here's the problem. 1 trillion times zero is zero.
Zero. Yeah. No,
That's
you're
that
right.
nominal confusion.
And people are definitely not only confused. I can tell you that. And I'm trying to
Absolutely.
help, you know, alleviate some of that confusion. And speaking of being confused, one last thing that I want to talk about before we get into ITM trading is I haven't researched much about this, and I hear you talk about this quite often. And I'd like to get a little bit more information, because you're saying if some of these things that we spoke about don't collapse the system, the LIBOR rates could be one of the catalysts.
Oh, no doubt about
So
that.
can you
Yeah.
explain what the LIBOR rates actually are, and how that could come to affect the system?
Yes, absolutely. Because with Wall Street, basically you can create these formulas and these algorithms and all of these things and put it into what's called the benchmark. So the LIBOR, or it's actually the IBOR,
Okay.
interbank offer rate, is the amount that banks would charge each other to loan. It is a stated rate. So these banks get together in the morning and they go, oh, I think interest rates should be here for short-term money and here. Well, it was discovered in 2012, although it certainly happened through the crisis, that, shocker, they were manipulating these rates. But here's the problem with that. These rates are tied into mortgages, credit card loans, auto loans, all these derivative contracts, etc. And once it was out of the bag that these were all not just stated rates, but stated and then manipulated rates, well, they couldn't really use it as a benchmark anymore. And they came out, I think it was the Bank of England, and I'm pretty sure it was 2012, maybe 13, but I think it was 12, when they said that by the end of 2021, the IBORs were going away. Poof, gone. So now you have something like $6.7 trillion in contracts that have this number, this benchmark embedded in them. And if the contract matures after 2021, that screws up all those contracts. So there are a couple things that have to happen, that are happening. And number one, they have to create a new benchmark. And a number of central banks have taken on that task: Switzerland, England, and in the US. And the US's new benchmark that they're trying to create a market for is called SOFR, S-O-F-R. But they're having trouble. Now, in Wall Street trading terms, no trouble, they're starting to adopt that. But for those that are issuing new debt contracts, so new mortgages, new derivatives, or anything like that, they're having a hard time adopting this new untested benchmark, which didn't fare very well during what just recently happened with the repos, by the way.
Right.
So they're not getting as quick adoption as they would like to, especially when one of the key players that issues debt in terms of SOFR are all of the mortgage makers like Fannie Mae, Freddie Mac, Ginnie Mae, and the Federal Home Loan Bank. So these are all governmental or quasi-governmental agencies. Freddie Mac issues the most of it. And then guess who buys them? Pension plans, mutual funds, all these things, which, you know, that you don't even probably know that you might own some things that are linked, some ETFs or mutual funds that have those contracts embedded in them. But the Federal Home Loan Bank was also one of the big issuers. Now they need regular corporations to issue them as well, but it's really slow adoption. And I don't know why, I haven't been able to find out why, but the Federal Home Loan Bank issuance of SOFR linked debt has dropped off really dramatically since August.
Oh, that's interesting.
It really is. And I can't find why, because you would think that the government agencies would be like, you know, Freddie Mae, Fannie Mae, all those guys would really be issuing a lot of them. And they were one of the key issuers. So there are a couple of questions, because every contract that matures after 2021 must be reset. They have to redo the contracts. If it's something that you or I own, no problem, because that language, their ability to do that is embedded in your mortgage and your credit cards and in any of those loans. We do not have a choice. But where the real danger zone comes is in those derivatives, because in a lot of cases, they have to get, and these are very, very complicated instruments.
Right.
They have to get 100% agreement. I don't know. So the race is on, because this is not being globally. It's not like they've got one benchmark that all the global central bankers came together, which would have made more sense to me.
Right.
At the IMF, the International Monetary Fund, everybody get together and go, okay, let's push this benchmark, because the IBORs were global. So you've got a number of countries that are working on their own, and they still have to create this market. But it did go on the ticker yesterday. They started publishing it on the ticker in an attempt to get more adoption. But
That's
we're
SOFR?
already in 2020.
You're talking about a ticker for SOFR?
Mm-hmm. SOFR.
Okay. And that went
So,
live yesterday. I have to check into that.
Well, yeah, because, you know, if they can't make this transition, then, you know, that, you know, I hate to give dates, but that's a date that the Bank of England gave.
Right.
So if the Bank of England gives a date, I can give a date, because I have no control over any other dates. But yeah, if the LIBOR goes away, or the IBORs go away on December 31st of 2021, and those contracts, all those contracts after that date have not been reset with the new benchmark.
Right. Bad news.
Could be game over.
Yeah.
I mean, even the ISDA, which is the I love these self-regulatory bodies that are made up of all the guys that have created all this mess. I mean, they're all talking about how challenging this transit. Will be a historic first. I don't think that personally, you know, I hope I'm wrong,
Well,
but I don't think they can do it.
Like you said, it's a con game. It's a confidence game, and confidence is starting to run out.
Yes,
so is there anything else that we should pay attention to, like that could be putting us in these positions where we could be seeing a collapse besides some of the things we've mentioned?
Well, you know, look, the central banks globally, when they did their pivot last year, remember at Christmas time, the markets were dumping like they had in 2008, right? And so the central banks did a pivot, promised them an ample reserve regime, which means we're going to give you as much money as you want. You know, look, I'm not saying that they can't keep this thing floating in a nominal way, but these are the most expensive markets in history, and they can't implode or you notice. The money markets can't freeze or you notice. And then confidence in the system, as much as that's declined, then it's lost. There's your hyperinflation. But, you know, so we'll have to see.
Okay. Well, I appreciate it. And
Exactly, you know, what happens, but yeah, market's
I
way
mean,
overvalued.
this has been a lot of information. I think it's, you know, it's a lot for people, especially people who follow my content, not necessarily your content, to just let it soak in and grasp, you know, because, you know, it's some pretty heavy stuff when you really think about it in reality. But so lastly, to wrap things up, you know, do you want to tell us a little bit about ITM trading and what you do there as a chief market analyst?
Absolutely. Well, I do a lot of research, you know, and my mission actually is to translate financial noise into understandable language so that you can make educated choices on what serves you best. And what, you know, I definitely do consider myself an artist in everything that I do. And so what I try and do on my channel is teach people how to recognize patterns so that you don't necessarily need to understand or know all of this gobbledygook. But if you can recognize a pattern and when there's a shift and just accept that, and then if you can also take a look at what the smartest guys in the room are doing for themselves, not what they tell you to do, but what they're actually doing for themselves, and you can position yourself in a similar way, well, then it kind of makes life easy. And so here at ITM Trading, you know, as you had said earlier, I've been studying currencies since 1987. And just like everything else, currencies have a life cycle. I have a granddaughter that's 4 or 5,
You should
and a
know this,
grandson
Grandma.
that's 6. Pardon?
You should know your grandchildren's age.
I should. I'm
turning 5.
bad. Oh, she's
Oh, so
turning
she's right
5.
on the
That's
cusp.
why I
Okay,
asked
that's
that.
fair enough. Fair enough.
Right, and just a little bit. That's why I was like kind of not sure. But I can guarantee you that they are at a different place in their life cycle at those ages that I am at 65. You know, and I have other grandchildren that are 13 and 11, and they're at a different life cycle than the smaller ones were than I am. And currencies are frankly no different. And what we're actually dealing with here is the life cycle, the end of life of a system. And they have to reset it into a new system. And I developed a strategy based upon those repeatable patterns. And that's what makes us really different than anybody else, is that strategy that I created for myself. And then here we have a whole team of strategy specialists that have been trained in all of this, that, you know, you're doing exactly the same strategy that I created for myself, but tweaked for you and your goals and your circumstances and what you have to work with. And we are very keen on education. You don't have to agree with me. You know, I love to give you the links, do your own due diligence. You have a different opinion than me? Okay, good. And I'm always open to hearing other opinions. And if they're really good arguments, I could even change my mind. But my nickname is Data Gal. That's what I go by. That's what the strategy goes by. And that's what we really like to do here, is get to know our clients and help them prepare to sustain their standard of living, and dare I say it, even thrive through it, so that on the other side of this mess, you are in a much better place than you were going into it.
I love it. It's a great philosophy, and I love what you guys do. I mean, that's obviously why I bring you on my channel for interviews. I mean, I do talk about cryptocurrencies, but I'm very, very strong on telling people to diversify, not as financial advice, but tell them the importance of precious metals, of gold and silver, because silver is a lot more obtainable for the everyday person. So I definitely encourage people to go those routes. And that's why, not only when it comes to gold and silver, I appreciate the research that you do. I mean, as that data girl, I mean, you do such well research. Your PowerPoints are very well put together.
Thank you.
And that's why I wanted to like bring more attention from my element, from my niche, you know, to come and check out a little bit more of what you're doing, because I think it's really important that people educate themselves, and I appreciate what you're doing in the education
Thank
department.
you.
So I'm going to have links down below for everything we talked about, so you guys can check out ITM Trading. If you're not subscribed yet already, make sure you subscribe and hit the notification bell. ITM goes live very often. I think it's like at least once a week, and you're putting out videos on a consistent basis.
3 times a week.
Okay, 3 times a week.
Yep,
So,
we do Q&A on Tuesday, and then I do a headline news piece and a research piece. So at a minimum, 3 times a week.
Cool. Awesome. And if this is your first time ever checking out any of my content, I do encourage you to explore my channel. And if you like what I'm doing, you can support me by subscribing, liking, commenting, and sharing. And as always, I encourage you to be the change by practicing change. And I love you all. And Forrest loves you too. Thank you for watching all the way through to the very end. Now, if you're not subscribed yet, what are you waiting for? And be sure to hit that notification bell so you can stay up to date with my current content as it comes out. I do got to give a shout out to this month's Rice Crypto Show sponsors who make it possible for me to create content. Monarch, Presearch, and BlockFinX, which is a new exchange that's going to be launching soon. Going to have links down below so you can check out my sponsors. And again, much love.